Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the business world to uncover what makes companies tick. And today we're dissecting Leapfrog Acquisition Corporation's S-1 filing. You know, the document that basically lays bare a company's intentions before it goes public. And let me tell you, this one reads like a playbook for a specific kind of deal, a big one potentially outside the United States. So buckle up because we're about to decode Leapfrog's strategy, their risks, and what they think could make them a hot ticket for investors. This filing is an amendment to an earlier one, essentially an update from Leapfrog Acquisition Corporation, a company that is essentially a shell looking for a business to acquire, a so-called blank check company. They filed this with the US Securities and Exchange Commission, or SEC, on the 24th of October 2025. Their mission is pretty straightforward. They want to find a business, merge with it, and become a public company through that combination. They haven't picked a target yet and haven't really started serious talks, but they're eyeing energy or infrastructure companies, especially those outside the United States. This offering is for 12.5 million units at $10 a pop. Each unit bundles one Class A ordinary share with half a warrant. That whole warrant lets you buy a Class A share for $11.50. The goal is to raise $125 million. Now, here is where it gets interesting. Their sponsor, Leapfrog Partners LLC and BTIG, which is representing the underwriters, are buying a bunch of these units privately, specifically 435,000 private units. The sponsor is taking on the lion's share of that, over 300,000 units, and BTIG is taking the rest. These private units are the same as the public ones, but they're sold in a private deal happening at the same time as this public offering. Even more interesting, some institutional investors, who they call non-managing sponsor investors, are showing interest in buying a chunk of these private units indirectly through the sponsor. This actually means these outside investors could get a better deal, potentially realizing enhanced economic returns compared to other investors in the offering. They'll be getting interest in founder shares, which sounds pretty sweet, but they won't get voting rights on those. They're not making binding agreements yet though, so this could still change. Let's talk about dilution. On the 6th of August 2025, the sponsor bought over 4.7 million Class B shares for just $25,000. That is about half a cent per S-share. This means public shareholders are going to face significant dilution right from the get. The Class B shares can convert into Class A shares. And get this, they might convert at a rate better than 1-to-1 because of something called anti-dilution rights. This could mean even more dilution for public shareholders. Here is a look at dilution in detail. As of the 6th of August 2025, the offering price per unit is $10, but the net tangible book value per S-share, before accounting for redemptions, is actually just over $7. This means investors buying in at $10 are already looking at an immediate dilution. If many shareholders redeem their shares, the dilution could get even worse, pushing the net tangible book value per S-share below zero in some scenarios. For instance, in the worst case scenario, where 100% of maximum redemptions happen, the holder's investment per S-share becomes negative. And the difference between the offering price and this negative value is a hefty $10.71 per S-share, indicating substantial dilution. There is a clear conflict of interest here. Since the sponsor and management team own founder shares bought at a very low price, they have a strong incentive to complete any business combination. Even if it is not the best long-term play for public shareholders, they stand to make a lot of money on their investment even if the company performs poorly after the merger. They've got 24 months or 2 years to find a business and make a deal. If they don't, they have to return the money to the shareholders from the trust account. This time pressure can lead to rushed decisions. Let's look at who is running the show. Matthew R. Pollard, the CEO, has a long history in investment banking and private equity focused on energy and infrastructure, particularly in Asia. Apay N. Pandey, the president and chief investment officer, also brings decades of experience in investment banking and private equity, with a focus on energy, healthcare, and infrastructure. Kevin M. Murphy, the CFO, has extensive investment management and private equity experience across Asia-Pacific markets. These guys certainly have the experience to find and assess complex international deals. The board members also bring a wealth of experience. Our Iron Angel has spent decades leading companies in energy and infrastructure with a particular focus on Southeast Asia. Kenneth Hyatt has a strong background in international trade and negotiation, having served in the US Department of Commerce VEDP. Narayan brings extensive senior executive experience in the technology sector, particularly in scaling companies across Asia. This collective experience seems geared towards international energy and infrastructure plays. Leapfrog is looking at significant opportunities driven by global trends. They're talking about increasing demand for energy due to digital infrastructure expansion, a resurgence in nuclear power, growing liquefied natural gas infrastructure needs, industrial reshoring, and strategic supply chain diversification. These are all massive global shifts that could present lucrative investment avenues, especially for companies with strategic positions in energy and critical minerals. Their strategy is all about acquiring established companies with clear growth potential in markets that are hard to enter. They want businesses with strong competitive advantages or moats, like unique assets or long-term contracts. They also value experienced leadership teams who are invested in the business's success. Now let's quickly flash over to the financial statements. As of the 6th of August 2025, Leapfrog Acquisition Corporation had a working capital deficit of over $170,000. They had total assets of around $216,000, mostly in prepaid expenses and deferred offering costs. Their total liabilities were nearly $200,000, primarily accrued expenses. This is typical for a company before an offering. Importantly, management acknowledges substantial doubt about their ability to continue as a going concern without the proposed public offering, but a commitment from their sponsor alleviates this concern for now. The financial statements show that the sponsor acquired 4,791,667 Class B ordinary shares for just $479, which, given the par value, is effectively a nominal amount, confirming that half-cent per S-share acquisition cost we saw mentioned earlier. This is a key point for understanding the dilution to public shareholders. They also have a promissory note with the sponsor for up to $300,000 to cover offering expenses. This shows the sponsor is providing some initial funding, which is also standard for these types of companies. But remember, this loan has to be repaid. Scroll overall, Leapfrog Acquisition Corporation is positioning itself as a SPAC with a very specific focus. Their management team's extensive international experience in energy and infrastructure suggests they have a clear idea of the types of deals they want to pursue. The significant dilution from founder shares is a major red flag for potential public investors. It means the insiders stand to make a lot even if the company doesn't perform incredibly well post-merger. However, the sheer scale of the market opportunities they've identified, particularly in critical minerals and international energy supply chains, could be very attractive if they can execute successfully. The biggest risks revolve around finding the right target within their year window and navigating the potential conflicts of interest stemming from their sponsor's ownership structure. It is a high-risk, potentially high-reward proposition, typical of SPACs, but their focused strategy and experienced team might give them an edge. Alright? That is our deep dive into Leapfrog Acquisition Corporation's S-1 filing. What do you think about their strategy and the potential for dilution? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe to Corporate Decoder for more financial investigations. And hey, join our Discord community linked in the description for even more insights and discussions. Thanks for watching, and we'll see you in the next one.